Okay, hi everyone. Let's spend a little bit of time and let's take a look at the basic financial statements. These are the basic financial accounting statements. The first one is the income statement. And you see the title right there. It's usually the second line. Usually when we're looking at financial statements, the first line is the company name, then the name of the statement, and then either an indication of the period in which it covers or the date on which it covers, and I'll get into that in a bit more detail. But the first financial statement is the income statement. I'm going to jump over to another sheet, and by the way, I've prepared this using Excel, so this may look very familiar to you. Okay, now the screen jumped and you get to see the second primary financial statement. It's the statement of stockholders' equity. And again, we have the company name as the first line of the statement. The second line is the name of the statement and then the period in which it covers. And in this case, we're talking about for the year ending December 31st, 2014. Then we have the balance sheet. Now the balance sheet is a little bit different because it only prepares a statement as of the end of business on a certain date. So here we're looking at the balance sheet at the end of the year on December 31st, 2014. And we'll get into that in a bit more detail as well. And then the fourth statement is the statement of cash flows. Okay? And the statement of cash flows covers a range of periods as well, or how I should say that it covers a range of dates. So it shows the transactions over a period of time. All right, let's go back and talk about the income statement. The income statement is usually the first statement prepared, and that's because the bottom line on an income statement is this item right here, net income. And we need net income to work on the next statement. So what's on an income statement? Well, it's a flow of transactions over time, in this case for the year ending December 31st, and usually income statements do cover either a month, a quarter, or a year. And we have the revenues less the expenses. Total revenues less total expenses gives us net income. Okay? Now what are revenues? Revenues are the cash inflows and other positive things that accrue to our business as a result of what we do in our business. So in this example, we're a selling business, but we also have a significant amount of interest revenue. And then we deduct various expenses to come up with that. Oh, and by the way, this should say total expenses. Okay? So that's the total expenses. Oh, if I could spell total right, that would be an improvement. Okay, so that's the income statement. We take principal positive cash inflows or other positive things that accrue to the business as a result of what we primarily do, and then we deduct all those necessary outflows and sacrifices we have to make, and I'm using words to describe expenses here, to generate those revenues. So in order to generate sales and interest revenue, we had to incur salary expense, advertising expense, depreciation expense, and utility expenses. Okay? And that generates net income of $35.5. And we need that number to flow to the next statement, the statement of stockholders' equity. Keep in mind that $35.5 because we're going to see that number again. Okay, next we prepare the statement of stockholders' equity. Now, if this were not a corporation, if it were a sole proprietorship or a partnership, it wouldn't be called the statement of stockholders' equity. It would be called the statement of owner's equity, or it might even just be called the statement of owner's capital. Lots of times these statements go by different names. In fact, let me jump back to the income statement. Sometimes the income statement is called the statement of financial results. There are other names it may go by as well. But back to the statement of stockholders' equity. The statement of stockholders' equity is really a reconciliation report. At least that's how I see it. We start off with a beginning balance. We figure out what increased, what decreased to compute an ending balance. Now, in our little sample company, we only have two components. We have capital stock and retained earnings. Okay, so we list capital stock, the beginning number, retained earnings, the beginning number, and then we add them together to come up with total stockholders' equity. Next, we show what increased stockholders' equity. And for the sample company, for the year ending December 31st, they had a new stock issuance of $20,000, and then they had that $35,500 of net income that we already saw on the income statement. So that comes forward. That's why the income statement has to be prepared before the stockholders' equity statement gets prepared. Next, we show the decreases. The decreases they had was $10,000 of dividends. So as a result, we had ending stockholders' equity of $100,000 of capital stock, $135,700 of retained earnings, for a total of $235,700. Now, we need that number too. In fact, we may need the 100 and the 135 to prepare the next statement, which is the balance sheet. Okay, now you see the balance sheet for sample company. Now the balance sheet looks a lot like the accounting equation. We have assets, and the total assets are equal to the total liabilities and stockholders' equity. So total assets were $279.5 in this example, and sure enough, total liabilities and stockholders' equity also come up to $279.5. Now, look at those numbers, $100,000, $135,700. That came from right here, our ending stockholders' equity. So this shows another interrelationship between the financial statements. And yes, the financial statements are related to each other. So there's we see the $100,000 and the $135,700 that came from the other financial statement. Okay, now the balance sheet also might be called something else. It might be called the statement of financial position. Now, one thing to notice as we look up here, the balance sheet doesn't give us the flow of transactions over a period of time. Instead, it just gives us a snapshot in time. So at the end of business on December 31st, 2014, we're able to see what the financial position is of the company. So we're able to see what they have, what's the value of their assets, what's the value of their obligations, which is another word for liabilities, and then we get to see the balance of their stockholders' equity. And as you know, stockholders' equity is the residual interest in the net assets of the company. Net assets means assets less liabilities. Okay, and then finally, we're going to look at the statement of cash flow. Well, let's look at that cash, $45,000. We're going to need that number. The last statement that we prepare is the statement of cash flows. Now, once again, this shows the range of transactions over time. And the statement of cash flow doesn't follow accrual accounting principles. Instead, it shows cash that went in and came out of the business. And we break it down into three areas. We break it down into cash from operating activities, cash flows from investing activities, and cash flows from financing activities. And this really should say cash flows from operating activities, okay? And the two principal items that we're going to see from cash flow from operating activities is going to be cash received from our customers and then cash that we paid out to suppliers and employees. When we net the cash inflows and outflows from our operations, we have a line item on the statement of cash flows that's called the net cash flows from operating activities. Next, we look at cash flows from investing activities. Now, these are activities or cash flows that had an impact on the long-term assets of our company. So in this particular example, our long-term asset was property, plant, and equipment. We saw that on the balance sheet. Here, I'll show you. Property, plant, and equipment, that happens to be a long-term long-term asset, which means we expect those assets to be here and not turn over within the next year. We had a sale of land of $8,000 that generated cash, and then we also purchased new equipment, and that used $12,000. So we had net cash flows from investing activity, and they were net cash outflows of $4,000. A positive number would be an inflow, a negative number would be an outflow. Okay? Finally, we looked at cash flow from financing activities. And here we had proceeds from the stock issuance. So the company issued $20,000 of additional stock. And we know that because when we go back to the statement of stockholders' equity, we saw the new stock issuance. But again, on the statement of cash flow, we're just focused on cash flows. So we had $20,000 proceeds from stock issuance. We had a dividend payment of $4,000. So the net impact to long-term liabilities and shareholders' equity really is provided in the cash flow from financing activities. Okay? So with those two events, we had a positive cash flow. Now, when we add up the net cash flow from operating activities, including the $4,000 deduction of the cash flow from investing activities, and then also add in the cash flow from financing activities, we have a net increase in cash of $36,000. We started off the beginning of the year with $9,000, ending with the cash balance of $45,000. Now that $45,000 number we've seen on the balance sheet right there. That's our $45,000 cash. So if we're going to highlight intercompany relationships, what we're going to do is we're going to highlight, actually we'll leave that as black. I'll change this to yellow. Make that black and I'll shade it to yellow, We'll say that net income on the income statement makes its way to net income under the retained earnings column on the statement of stockholders' equity, and then these ending balances here, actually total stockholders' equity as well, are needed to show up on the balance sheet. And then finally, the last interrelationship between the four principal financial statements is cash. And we see that $45,000 of cash showing up as our bottom line on the ending cash balance. Okay, so this has just been a brief introduction to the four general purpose financial statements. Thank you.